As a real estate agent, I understand that maintaining a high quality of life is becoming a challenge for many Canadians amid rising prices for basic necessities. And for many people, the most significant problem is housing. According to the latest inflation report, mortgage interest costs surged by 25.4% year over year in March, and rent prices jumped 8.5% over the same period. The state of the housing market has a ripple effect also on economic growth, consumer spending, investment, and even the internal migration of Canadians from city to city in search of more affordable housing. Halifax, for example, is experiencing one of the greatest booms in its history, with construction cranes all over the city, as people move there not only from Southern Ontario, but from Metro Vancouver as well. We are in a very dynamic moment in real estate in many parts of the country, which is exciting or frightening or both for many people. So to help you navigate all of this right here in Toronto and GTA, I've distilled some key insights from recent statistics, business reports, and government policy initiatives. There is a lot happening in housing right now, so here are some things you really need to know to succeed in the current environment. The first thing you need to know regarding Toronto and the GTA is that detached and semi-detached house prices are expected to rise modestly over 2024 and probably into the first half of 2025 too, as affordability issue keep many buyers on the sidelines. So even though the market began to pick up in December and January in terms of listings, sales, and prices, the market is likely to remain subdued over the next 12 months. Many analysts feel that interest and mortgage rates have to fall a full percentage point before the market will really begin to gather steam. So modest growth is likely to be the picture in Toronto and the GTA market for the rest of 2024. There is pretty wide consensus among analysts that the Bank of Canada will start cutting rates next month in June, perhaps reducing rates by a full percentage point this year and another percentage point in 2025. Former Bank of Canada Governor Mark Carney was warned that the pace and depth of rate cuts is likely to be slower and more shallow than the parallel increase in rates we've seen over the past 18 months. So it is impossible to say exactly how interest rate policy will shake out over the next 12 months. In fact, if inflation were to show signs of starting to rise again due to real estate or any other major sector, the Bank of Canada might well have the decline of rates to send a signal that the bank will not tolerate a return of strong inflationary pressure. In terms of regional price trends, it may be that cities like Guelph and Kitchener-Waterloo, which saw significant price correction recently after overheating during the pandemic, will become attractive markets for buyers in the near term. By contrast, we can expect that Toronto and the GTA will likely to see significant price rises again by summer of 2025 in detached and semi-detached homes, if not in condo markets. As rates fall, buyer confidence grows and the market begins to expand more robustly. As anyone who is paying attention to national housing policies will know, the federal government has been very active on the housing file over the past few months. Ottawa wants the provinces and municipalities to streamline zoning by law and approval processes to speed up the construction process and thereby increase the supply of housing. The feds have even promised to punish provinces by redirecting federal infrastructure spending if some provinces don't move on these regulatory changes. Both the federals and the provinces also want to encourage more workers to enter the construction trades via provincial training and apprentice programs, as well as via federal immigration initiatives to attract more construction workers to Canada. Canada is the only country in G7 that does not have a border with the low-wage country, or at least close proximity, as with Japan's relationship to Vietnam and the Philippines, while Western Europe sees significant inflows of construction workers from Eastern Europe, and the US housing benefits from a parallel influx of workers from Latin America. Canada has no such easy access to international construction workers. This is a major factor contributing to our housing supply problem relative to the rest of the G7. Due to these labor problems exacerbated by the aging out of many Canadian-born baby boom era construction workers, there are moves afoot to adopt less labor-intense approaches to home construction by bringing more prefabricated prefabricated and modular houses into the marketplace, thereby expanding the supply of housing units more quickly. Virtually all policymakers agree that we also need a better mix of housing start. More rental apartment and social housing are needed, for example, to help meet skyrocketing demand in these two areas of the market. In the recent federal budget announced on April 16, Finance Minister Chrystia Freeland set out the following measures to help boost the housing start. She extended the capital cost allowance and gave GST rebate to contractors to encourage them to build more rental units. She also raised the RRSP withdrawal limit for first-time home buyers and extended the amortization terms to 30 years to make it easier for buyers to finance their first home. On another front, outside of the budget, Ottawa is also proposing to reduce the number of incoming foreign students and other non-permanent residents to reduce housing demand and thereby provide some breathing room to supply to catch up with the powerful demand pressure in the market. Most of these initiatives on the part of Ottawa are applauded by market analysts, but there is also very broad agreement that despite the federal government's welcome return to the housing market after a long absence, the measures they have taken today are too small to make a real dent in a yawning gap between supply and demand for housing units. So the main takeaway from all the recent policy initiatives on housing at every level of government is that these measures are not going to change the fundamental dynamics of the real estate market in Toronto and the GTA in the near term. If these initiatives are going to have a positive effect on housing affordability, they are only likely to be felt in the medium and longer term. Indeed, very sadly, housing start may well decline in the short term due to recent interest rate policies targeted to fight inflation. So what does all this mean for you in the here and now of buying and selling real estate in Toronto and the GTA? You will find the answer to this critical question in the next video. Whether you're buying, selling, or just love exploring real estate options in Toronto, I've got plenty more to share. Feel free to contact me directly or schedule a call using the calendar link in the description below. Remember to subscribe and let's navigate the Toronto real estate market together. Thanks for watching. See you in the next one.